De-dollarization in international economics. Key debate surrounding economic stability versus diversification, role of technology, geopolitical dynamics. De-dollarization refers to the process of reducing reliance on the US dollar in international trade, finance, and reserves. The US dollar has long been the dominant global currency, underpinning the majority of international transactions and serving as a primary reserve currency for central banks worldwide. However, growing geopolitical tensions, economic shifts, and diversification strategies have amplified debates surrounding de-dollarization. This analysis delves into the various scenarios and consequences of de-dollarization, considering perspectives from key stakeholders in the global economy. Scenarios of de-dollarization. 1. Gradual de-dollarization. Scenario: countries incrementally reduce their dependence on the US dollar by diversifying foreign reserves, increasing trade settlements in local or alternative currencies, and promoting regional monetary cooperation. Key drivers. Sanctions imposed by the United States, often involving restrictions on the use of the US dollar, motivate affected countries to reduce their reliance on the dollar. By settling trade in alternative currencies, these nations aim to minimize the impact of sanctions and safeguard their economic activities. Geopolitical risks. The dominance of the dollar ties countries to the US financial system, exposing them to vulnerabilities from political decisions or global tensions. Diversifying currency use reduces dependency and mitigates the risks stemming from shifts in US foreign policy or global instability. Technological advancements in financial systems, such as digital currencies. China's Belt and Road Initiative promoting yuan-denominated trade agreements. 2. Regional currency blocks. Scenario: countries within certain regions adopt shared or dominant regional currencies for trade and reserves. This could include the euro in Europe, the yuan in Asia, or a potential Gulf Cooperation Council (GCC) currency in the Middle East. Key drivers. Trade intensity within regional blocs. Regional political alliances and economic interdependence. Example: the European Union's success with the euro as a currency for trade and reserves. 3. Emergence of digital currencies. Scenario: central bank digital currencies, CBDCs, and decentralized cryptocurrencies become significant players in global trade and finance, reducing reliance on the US dollar. Key drivers. Enhanced efficiency and transparency in digital financial systems. Declining trust in traditional fiat currencies. The potential for bypassing traditional financial systems, especially under sanctions. Example: China's digital yuan project aimed at internationalizing its currency. 4. Rapid de-dollarization. Scenario: an abrupt decline in dollar dominance due to a significant geopolitical or economic event, such as a large-scale conflict, a collapse in U.S. fiscal stability, or loss of confidence in U.S. monetary policy. Collapse in U.S. fiscal stability. If the United States were to face unsustainable fiscal deficits or fail to manage its national debt, it could lose its credibility in global financial markets. This loss of fiscal stability would undermine confidence in the dollar as a reliable reserve currency. Loss of confidence in U.S. monetary policy. Should the Federal Reserve's monetary policy fail to control inflation, ensure stability, or maintain credibility, international stakeholders might begin seeking alternatives to the dollar. This could happen if policy decisions are perceived as overly politicized or unpredictable, shaking global trust. Both scenarios underscore the risks of over-reliance on the dollar and the fragile balance underpinning its dominance. Key drivers. Overuse of dollar-based sanctions, where the United States excessively employs economic sanctions that leverage the dollar's dominance in global finance. These sanctions typically restrict targeted countries or entities from accessing the U.S. financial system, conducting dollar-denominated transactions, or using U.S.-based financial institutions. Accelerated debt crises linked to dollar-denominated obligations. Financial crises can arise when countries or entities face challenges repaying debts that are denominated in US dollars. These crises can be triggered or exacerbated by certain factors. Exchange rate volatility. If a country's local currency depreciates significantly against the dollar, the cost of servicing dollar-denominated debt rises sharply, putting immense pressure on the debtor's finances. When the U.S. Federal Reserve raises interest rates, borrowing in dollars becomes more expensive. This can increase debt servicing costs for countries and businesses reliant on dollar loans, particularly emerging markets. Liquidity constraints. Countries dependent on dollar inflows for trade or investment may struggle to acquire sufficient dollars to meet their debt obligations during periods of global financial stress. Such crises can lead to defaults, economic recessions, and destabilization of financial systems in debtor nations, often amplifying calls for reducing reliance on the dollar in global finance. Rising alternatives to the dollar with global trust. Example: the aftermath of major sanctions against Russia post-2022 invasion of Ukraine, leading to increased trade in rubles, yuan, and other currencies. Consequences of de-dollarization. From the U.S. perspective. 1. Economic impact. Declining global demand for U.S. treasuries may increase borrowing costs. If fewer countries and investors want to buy treasuries, the U.S. would need to offer higher interest rates to attract buyers, increasing borrowing costs. Reduced ability to finance deficits by issuing dollar-denominated debt. The U.S. government heavily relies on selling treasuries to finance its budget deficits. A decline in demand could make financing its debt more expensive and strain fiscal resources. This highlights a potential consequence of de-dollarization, as countries diversifying away from the dollar may also reduce their investments in U.S. treasuries. Potential for inflationary pressures. As global dollar holdings diminish, lower demand for the dollar could lead to a depreciation of its value. Higher import costs. A weaker dollar would increase the cost of imports to the United States, driving up prices for goods and services. Inflationary pressures. The rising cost of imports could feed into domestic inflation, increasing the overall price level within the U.S. economy. This situation highlights a key risk of de-dollarization from the U.S. perspective. If global confidence in the dollar wanes and holdings decrease significantly, it could undermine price stability in the domestic economy.